Hi, I'm Aoife Devitt, and welcome to today's Markets Happy Hour podcast. This is a special edition featuring a special guest, Paula Campbell Roberts from KKR. Welcome, Paula. Thank you for joining us here.
Terrific to be with you, Ethan.
Well, we're recording this on Wednesday, November 5th. We are just coming off some election data results in the US. We're not going to discuss the politics of it all, but it certainly will have an impact on the economic outlook markets, perhaps, and on some of the policies in effect. So let's bring up the slides and kick this off. Well, I've called this podcast the Ayes and the Nays. Certainly, election is on our mind, but we also have some ayes and nays in case when we're speaking about whether people believe in the AI trajectory as it is. We have some naysayers, some quite prominent ones, and we have some ardent supporters as well. So we'll be discussing that. As usual, we go through 5 topics, and the way we're going to run this podcast, I'm going to go through some of our points of view at Moneta initially, and then Paula is going to open up a discussion, and then she's going to share some of her views towards the end of the podcast. So a little bit of a slightly different running order, but looking forward to kicking in. Inflation, interest rates, equity markets, geopolitics, and other factors. And then the discussion with Paula, we're really going to talk about implementation and how we think about portfolio construction. In today's podcast, inflation has moved clearly onto a bit of a power play, and that is a play on words, but we're discussing power and electricity. We're going to be looking at the rates picture and whether the Fed is on its trajectory towards easing or whether anything in the last few weeks has changed that. We will be looking at how investors are leaning in to the AI debate and the I and the naysayers debate we mentioned earlier. China still looms quite large in all of these discussions, whether it be around tariffs or otherwise, and then we'll look at portfolio implications. So here is Paula. She is the Chief Investment Strategist for the Global Wealth Business and a Managing Director on KKR's Global Macro and Asset Allocation team. And we've featured her before on Moneta podcast, so delighted to see her again. And she does touch on all of these topics. So I'm going to lay out the Moneta stall and we'll go from there. So last week we spoke about how inflation was hovering now around a new normal of around 3%. The 2% limit seems to not quite have been reached, or at least the 2% target. And we're now sort of settling into a slightly higher rate. We know anecdotally, relying on anecdata, that food prices still are pinching not only at the low end consumer, but I'd say the mid-level consumer too. But the consumer has been slightly saved by the lower oil price and energy price, at least in terms of oil at the pump. What we are seeing, though, is increasingly a concern about electricity prices. Certainly, as we come into the winter season, we will be looking at electricity usage. The days are already getting shorter, and we can see that while power did take a declining share of US consumers' living costs until 2000, that share has now been ticking up. And similarly, on the chart on the right, we can see that electricity CPI has been rising more quickly than US headline CPI. So clearly, very much something that is top of mind for the consumer as we enter the winter. Clearly, also the massive excitement around data centers and the build out and the scale there is naturally flowing into a question about how will we power these data centers. And I've said the word concentration metrics because thinking of the concentration we've seen in equity markets, but we're seeing a tremendous amount of concentration around electricity consumption of data centers today, with data center consumption now alone now starting to rival that of individual countries. So clearly a massive demand for power there. And it has become a bit of a political wedge as well as it inserts itself into the debate around whether or not data centers can be built. So I think we're going to see increasing focus not just on fuel and food costs, but also on electricity costs as a component of that overall inflation picture. Looking at bonds, the eerie calm continues in public fixed income markets. We have the move index expressing the volatility in fixed income really quite low and suggesting that at least public fixed income investors are not particularly concerned about credit or about current pricing in bonds. On the other hand, VIX has been moving around a little bit. It's low currently, but has been rising. And we know that some of that stems from the concentration in equity markets and just that real focus on those concentrated names and the fact that they do tend to move in a more volatile fashion. But I've used the title here, Bonds Are Unburdened by What Has Been. There is a real sense of them being unburdened, unbothered at this point. question whether some of that burden and bother has shifted into the private credit space. And I think we can definitely take that up in the discussion. But for now, relatively smooth waters when it comes to fixed income. Then equally, no particular news this week as to whether the Fed would change its trajectory in terms of rates. Moving on to equity markets, still a lot of focus on these big names, the top 7, top 10, and the fact that there actually has not been necessarily a linear growth in these stocks, and that some names such as Nvidia have doubled in size, certainly in the last 5 years, if not more, more than doubling. And that has been in sharp contrast to the other companies such as Tesla that have ticked along, still representing a large amount of equity markets, but not seeing that kind of staggering uptick in their share of the top 10. And the other key factor around these top names, of course, and this is just 4 names alone here, is the focus on capital expenditure. We've talked a lot about that around AI, just how much is coming, how much has already been committed, and how it is being committed, such as has it been committed through a complex web of agreements such as what we have in place with some now between OpenAI, say Nvidia, and equally, is it being committed from cash that is already there on the balance sheet, or at least coming in nicely through revenues? We know that is the case with, say, the likes of Alphabet or Amazon. Or will there be a need to go to the credit markets to fund this expenditure? And the next slide shows that there could well be, this slide here in terms of net debt, there could well be more going to the credit markets in order to fund this AI, particularly Meta, Microsoft, Amazon. These are firms that are likely to have to go to the credit markets at this point because their expenditure is simply so high. So just going back to some of those stratospheric spending numbers that are now being discussed, we have now got some evidence that the CapEx growth is matching that of the tech bubble, 99-2000. So again, somewhat out of our realm of what we can imagine in terms of expenditure numbers, but this is perhaps why the bubble territory and words have been used. And then looking also at the infrastructure stocks, there's already been quite a significant participation by those stocks in the current run up, and that they've actually outstripped the Magnificent Seven. So already a move into the picks and shovels of the AI story. Getting back to this borrowing, what we can see is that borrowing to fund AI data center spending has exploded in September and so far in October. This is from Bank of America Global Research, this chart here. That borrowing is coming from investment grade bonds, from loans, but a dramatic uptick from 2024 in terms of borrowing to fund AI expenditure. So this is when things start to get a little more precarious, perhaps, is when we know that financial instruments and engineering needs to be behind some of these massive spending commitments. And this, I think, is why we are seeing this focus on the bear case. And this is just a quote from Twitter, from x.com, from the famous Michael Burry, who featured in The Big Short, who is known to have called the subprime crisis quite early. He seems to be ringing alarm bells about a bubble, but actually that the whole point of this particular tweet is that he doesn't feel there's much he can do about it, because he suggested that there was forces at play that would essentially run in to support markets in the case of any trip up. That certainly, we know that the Fed has arsenal in the form of these current high rates to step into markets. But this kind of negativity, the shorting, has been sending a bit of some fears into markets just in the past few days. On the other hand, we are seeing other positive indicators in markets, the very strong earnings backdrop that we have just come off, as well as the fact that M&A has looked buoyant. I say to a point, in that it is actually coming down month on month, but we're still looking at pretty positive global M&A volumes, certainly relative to 2022 and around the COVID time. So that is sending some cheer, some holiday cheer to investment bankers and others levered to that. So then finally, just in terms of China, we've spoken before about China trade tensions. Really is something that is continuing to roil markets anytime they come up. We have seen, though, that there has been China exposed stocks who have actually rallied the most since Liberation Day. So definitely a strong, I'd say, awareness within markets of the codependency of some of these tech stocks on the China market. Finally, my final point on my set of slides is around the dollar. I'd say after having had a very strong dollar for reaching peaks for some time, we then rotated to more of a weak dollar thesis. There was a sense that this might have been intentional on the part of the administration, that a weak dollar was beneficial. There was also a sense it perhaps came out of fears around the US position on the global stage, concerns around the fiscal budget deficit, and maybe was the antidote to some of the gold demand. But it does seem now that since the recent strong market new heights being reached, that the dollar is starting to look strong again. And according to this chart, it is looking its strongest since the Liberation Day turmoil. So that is a bit of a twist in the current narrative. So those are my slides for today. Those of you listening, and we will now switch to discussion with Paula. And I will keep the slides up for a little bit, Paula, in case there's anything you wanted to refer back to, and then we can move to yours. But I'd love to hear your response or thoughts on those points.
Fantastic, Ethan. Thank you for running through that and sharing Monetta's views. It's interesting, as I was listening to you, it paints the story that I tell as well, which is there are countervailing data points, right? Which don't describe like a consistently overheating economy or a consistently underperforming economy, and hence why people are talking about this sort of K-shaped economy, right? As I think about some of the major points that you're making, overall, I agree with you, starting with the inflation point, and we can bring up that slide. I, for some years now, believe that we're in a structurally higher inflation environment. And this is even before considering energy, which is, the very good point you were making around not just data centers, but energy for the consumer. I think because of the shift in geopolitics, because of what we're seeing around wage growth, because of AI, so including data centers and even just the energy complex around critical minerals, that we are in a structurally higher inflation environment. So your 3% we agree with, and I don't think we're headed far lower than that anytime soon, especially when you consider the fact that we're at these high levels of inflation and rates are this high, right? And we're going to continue cutting rates. So rates are helping to constrain inflation, but they're headed lower. So that downward pressure is going to be removed. So I agree with you that inflation trends higher. On the energy costs, it's interesting. I agree with you that we should brace ourselves for higher costs because, in the US over the past 10, 20 years, energy price growth or energy consumption has been flat. And going forward, just because of data centers, we expect that to grow on a CAGR basis, right, to 2-3%. So that's massive, especially when you think on an individual basis how much energy data centers consume. That plays into the consumer, but as you know, from a Fed perspective, the Fed is thinking X energy, X gas. So that's not necessarily part of the Fed's thinking. That said, our goal, our forecast is that the Fed cuts one more time this year and then cuts 3 times next year. What's interesting about that is the dispersion around those views is at its widest levels right now, right? Because back to the same point you're making, I'm making, there's some people who say the economy is great and other people say the economy is extraordinarily weak, right? And there's truth to both points of view. I would argue that the GDP numbers are clearly surprising to the upside, but embedded within the GDP numbers are really amazing investments in AI, right? And when you strip out, if you're, it's a complicated process, but if you could strip out AI investment, growth is not as strong, right? And you're talking about a weaker labor market, housing has been weak, and there are businesses whose balance sheets or business models are not withstanding these higher interest rates. So it's sort of a both and. But I find that interesting. So that's the Fed. Maybe a couple of more points I'd make. I think your AI point is an interesting one. Clearly, there's a lot of concentration risk in the S&P, and so you're seeing tech stocks drag global markets down when as investors are concerned about AI and sort of Peter paying Paul and what pod is driving the AI boom. I'd say fundamentally for companies and for the economy, we need AI to support productivity, and that is what is going to drive growth. We no longer can rely on population growth or working age population growth to fuel the economy. So it's all about productivity. And how are we going to get that productivity? It's through AI, right? And so um, it is true that not all of this investment is going to be productive, in my view. There will be winners and losers. And so you have to be careful about how you're invested. For ourselves, we think about investing in the compute infrastructure. So, yes, the data centers, but the data centers that have real demand drivers behind them. But then the power networks, to your point, are going to be needed regardless. But I would say there probably are bubbles within AI, but AI in of itself is going to be critical for future growth. Maybe the last 2 points I'll make before if you agree disagree with anything I've said, Ethan. But on M&A, I think that's been interesting. Where coming into this year, everyone was excited about Animal Spirits being released, and this is going to be such a strong year, and then it turned out to be disappointing in the first quarter. I think we are seeing, though, positive signs that IPO activity is rebounding, which I think adds just greater optionality for companies who are seeking capital, for exits, for sponsors, investment banks, as you named. I also, though, think it's important to note that private equity firms, and of course we are one, don't just rely on the IPO market or on M&A, right? And so they're sponsor to sponsor, there's strategic exits, there are lots of other opportunities. So even though I think it's good for the industry and certainly good for banking that IPO activity is rebounding, I do think it's worth it to just note that private equity doesn't just rely on public exits for their deals. And then maybe the final point I'll make is on the dollar. I take your point that in the recent month, the dollar has looked better. I think that the dollar overall, though, has been probably overvalued relative to other economies coming into this year, and we saw some of that correction taking place. I think from here, the dollar, because it still remains the reserve currency, doesn't have far to drop. But I also don't think that there's going to be massive appreciation because relative growth, US versus Europe and Asia, has fundamentally shifted. And I don't think that's going anywhere. The productivity story still hangs in the US, but relatively, you're seeing greater investment in Europe. You're seeing, more stimulus, monetary and fiscal in Asia. And the US is actually constraining fiscal support in some ways. So I think the dollar in the most recent month is responding to, some better news on tariffs, some better news on growth. But I think long term, structurally, the dollar is not going to strengthen a ton from here. So, what do you think about that, Ethan? Is that
That's a really fascinating, and I think, really fascinating because obviously, we both, I think, would probably advocate global investing. So that
yes,
just on that dollar
yes,
point, whereas the strong dollar has really been a double whammy for this underperforming non-US market, then it has been a little easier then with a weaker dollar to just justify having that global exposure. I'd say equally for the global investor, which has had an overweight to the US, and it's been difficult really to get away from that overweight just because of just where the roads are leading in terms of this concentration. The foreign investor has actually really been suffering with a weak dollar because they've seen that return eroded. So I think they probably are quite happy to see this stabilization and on the one hand, because it's been harder when they have so much overweight in the US dollar. And I speak from London, just knowing how many institutions here have been quite overweight the dollar. And while a weaker currency was good for them for a while, in terms of boosting, at this point, it's been a challenge. One of the points I love to ask, and this kind of segues nicely into your asset allocation discussion, is the twin factors of, as we mentioned, the higher kind of, I think you used the great term resting heartbeat, or that comes from KKR, but that's
yes,
yourself
heart
or
rate,
Henry
yeah.
McVeigh. It's just perfect. So if that resting heartbeat is higher, which I think it is at 3%, and yet the rates are coming down. So we have real
Mhm,
rates therefore coming down and being eroded
mhm.
by and the inflation rates of any return being eroded by this inflation. Doesn't Where does that drive investors then? Does it drive them out of cash, out of fixed income, into higher yielding equities or equities or other assets just in general? And how do you think that phenomenon, because in a way they've been able to relax with cash for a while, it hasn't been a drag?
You're exactly right, Ethan. I would agree that in this environment where we're talking about slowing the positive growth, where rates are coming down, that you want to rethink your asset allocation. And the points you made, I agree with. I'd add some others. The cash trade has been a wonderful one, given where rates have been in the past few years. It's going to be less economical, especially as inflation stays higher. So you want to make more productive use of your cash. Fixed income becomes more interesting, right? Because you're talking about rates coming down. So, imagine that we'd have more flows into fixed income. I think you still have to be careful about the diversification and the inflation piece of it. But relative to where we were, a few years ago, I think fixed income becomes interesting. Where and I'm a little biased here, but where I think there's even more compelling opportunity is in the private market landscape, where if you look at public markets, public equity versus private equity markets, most, and this is in the deck that we'll go through shortly, but most analysts in the past 5 years, if you look at the performance of the Mag 7 and the S&P, it's been, 15, 16% CAGR, right? And so that US exceptionalism story has borne through in real returns. Going forward, however, given where valuations are, given the fact that you can't rely on multiples because rates are higher, inflation is higher, it's just very difficult to get there. And so I think in our chart that we have, we're penciling in on a go forward basis of 6%. So the 16 drop to 6 is massive. And so you think about filling that gap. And what I like is if you look at private equity, while all private markets asset classes are subject to this higher rate environment, you're seeing the fact that one, valuations are not as stretched, number one. Two, there are just more ways to win. And so I think for private equity, we're going, on a median manager level down from, I think it's 14 to 12. So it's a much better delta versus what you're seeing in the S&P. So that's cause, I think, for finding more opportunities to bridge that gap when especially public equities aren't going to deliver as much going forward.
Oh, fantastic. Well, this is probably a good time to bring up your slides and talk a little bit about the how you think about the kind of so what of all of this in terms of implementation to close us out.
Absolutely, Ethan. So I won't go through we publish this playbook on a quarterly basis. It gives you sort of a quick taste of how we're seeing the world, and then slides that you actually can use with your own clients on several of the points that I've made so far. But if we jump to, I think it's like 3 or 4 in here, I'll walk you through the framework. Ethan, I think what we've been talking about, we've been sort of talking around some of these factors that are displayed well on this page, which is there are a lot of shifts in the economic environment that reflect the fact that there are just fundamental structural changes, and that is driving a higher inflationary bias, higher inflation volatility, and that's causing the need for a new asset allocation. Because what you'll see in the next couple of pages is that from geopolitics to demographics to AI to shifts in the energy transition and fiscal support, that is creating a new relationship between how asset classes perform on a go forward basis. So you're getting lower asset class returns in many areas. Correlations are shifting. And so you need to think about building a portfolio that allows you to win in this new environment versus what worked maybe 10 years ago, right? So on the next slide, this is, some of the data supporting what I was just talking about 5 minutes ago with regard to expected returns. The gray bars are the 5-year historical returns. The purple bars are the go forward returns. And we've been doing this analysis for 10 or 15 years. But the point is made here where, if you look in the middle here, the S&P 500, this is the point I was making where prior 5 years looked great, but going forward doesn't look as good. A point that I didn't make is that credit in general is looking better. So I mentioned fixed income. I would also say even more so asset-based finance, which is a form of private credit where you're also getting access to fixed rate credit, but you're also getting an illiquidity premium. So I find that very exciting because you get what I just described, but also inflation hedging in addition to the downside protection. On the right-hand side here, I think infra and real estate hold up pretty well. It's interesting to see the real estate story going forward because clearly it's been a beleaguered asset class in the past few years, but going forward, it's set up to do much better. And then private equity. Here's the point I was making around, prior 5 years versus a former. All equity-oriented classes or equity-oriented asset classes perform not as great as they did over the past 5 years, but you see that the drop is not as extreme as what you see in the S&P. And then maybe the final point I'll make here, even back to what you and I were discussing in terms of diversification. If the S&P is not performing at 16, but you look at Europe and you look at Japan and you can get better returns over the next 5 years, I would not say, I would still hold on to an S&P allocation, but I would certainly diversify into Europe and Japan where you're getting pretty strong returns, even on a dollar adjusted basis.
That's a really
So,
interesting. Oh, sorry, just one question, if you don't mind, on that chart,
sure.
on that page. So the illiquidity premium, I guess we use that term, but we don't really look at the kind of shades of illiquidity that are possible, and that we have interval funds on the one hand, and then we have super long lockup infrastructure funds, or almost akin to permanent capital on the other. How do you see that? Will that be reflected kind of like for like in the premium?
Depending on the product you're
Right.
saying, so will the
Yes.
illiquidity premium differ? I
Yeah.
think it depends on the manager, right? So if you're talking about managers where the underlying investment is the same, then you're going to get access to the same types of liquidity premium. Because in our case, in the private equity portfolio, in your drawdown vehicle or your evergreen interval fund, it's the same underlying investment. So that illiquidity premium is there. What is different is, as opposed to getting 100% exposure to private equity, and essentially that's what you're getting in a drawdown, maybe 10, 20% of that is in a liquidity sleeve. And so if you hold that aside, the liquidity premium should be the same. But that liquidity sleeve, of course, is not offering you in sort of cash equivalents, that's not offering you an illiquidity return.
Fantastic, because that's of course something that's, I think, we're seeing so many new products in the private wealth sphere with different promises of liquidity, some of which have never been tested in an actual downturn or a crunch. It's quite interesting.
This is another point that I made regarding in terms of what to do and when to enter and how to lean in, especially at this point in the cycle. So in general, I'd say building on that page and overall, collateral-based cash flows are what sets you up to win going forward. If you're worried about volatility, if you're worried about inflation, being in cash flow generating asset classes does well. So think infrastructure, which, in historically had been these like long 10-year vehicles. Today, they actually are in evergreen vehicles, or even the run of the mill drawdown is a shorter term vehicle. And so you're getting exposure to assets that have more alpha in them. But infrastructure is one I get excited about because the cash flows reset with inflation and you get that downside protection in addition to exposure to secular themes. I think asset-based finance is another one. And then even real estate, and which you can toggle on the credit and equity side. And this page just makes an additional point, which is when you enter matters. So if you're entering the S&P at high levels of valuation, it's just much harder to generate a high level of return. Whereas you get in places like real estate equity, for example, where you can get a bargain and the fundamentals are still there, it's easier to generate that return going forward. Next slide here, please. And so as you think about building a portfolio from those building blocks of public and private markets asset classes, we put this together, which many advisors have found helpful to say, depending on your goal, you might build a different portfolio, right? Which makes a ton of sense. Your portfolio that's focused on yield is different from your portfolio that's based on return, on maximizing return. And using almost stylistic radio buttons, what the first bar or column shows you is if you're starting with a 60/40 portfolio and you want to generate more income, you would fund the portfolio from public equities because it's less yielding and allocate to private credit and then in turn real estate and private infrastructure. If you were more concerned about downside protection in addition to income, portfolio looks similar, but really the over allocation is to private credit and infrastructure because infrastructure has lower risk, more downside protection. But in the latter case, if your most important goal is to maximize returns, then private equity is where you get the over allocation. And in that case, you're funding from both public equities and from fixed income. On the next slide, I think I pull all of these together because we try to be agnostic to the actual percentage on that page, given the fact that, globally, the average allocation to private markets, I think is still 3 to 4%, right? Even though institutions are in the 30, 40, 50%. And so we didn't want to be prescriptive on that page. But on this page, if you use Monte Carlo optimization and insert returns, correlation, volatility, yield, and say optimize the portfolio around those parameters that I just described, including liquidity, it tells you that these portfolios would be the best able to achieve your outcomes. So that's in the first case. I think it's a 15% allocation to private credit. In the second case, it's a 12% allocation to private credit, 7.5% to infrastructure, and in the case where you're maximizing return, it's a 15% allocation to private equity.
And thank you so much, Paula. I found that fascinating to bring it back to the objective and think about it in terms of income preservation or return seeking. And then I think the whole point that we would both agree with is, of course, the goal is an all-weather portfolio. We are seeking to insulate
Exactly.
a portfolio from the kind of cataclysmic outcome that Michael Burry was predicting in his tweet, or a bubble bursting. And certainly having, whether you believe in US exceptionalism or not, or in the AI story or not, having exposure across the spectrum in terms of infrastructure, picks and shovels, actual stocks, as well as across the liquidity spectrum seems to be the key. So thank you so much for sharing those very rich insights with us. And thank you everyone for listening to the Markets Happy Hour podcast.
Thanks for having me, Ethan.